Hey guys, Mike here. So another green day in the market, slightly you could say. So that was a good thing. There's a few things I want to clear up and talk about because I'm starting to see in the comments some people are surprised that this is happening or that's happening, or maybe don't understand what's truly happening. But next week, remember we got CPI data coming out, which will be key, right? Where we get a big drop or not. And according to as a chart I showed you yesterday, if you haven't seen that video, I'll link it at the end. But when it comes to what manufacturing pricing actually is, it's come down quite a bit versus what we're actually paying at the stores and what the retailers are paying. And so, there's one major thing. You got to remember this right here. What's happened to gas prices, right? Let's look at what's come down. We know housing prices are coming down, which we'll talk about in a second. And really the big one probably is oil and gas, right? That's the one that affects everything. And I'm definitely learning that a lot of people don't understand why gas prices came down so fast. And the easiest way to think about this is, what's happening in November? November 8th, we'll have an election, right? So politicians got to get reelected. So what do? They buy your votes, right? And both parties are doing it at the state level and the federal level, okay? So at the federal level, how do you get gas prices down really fast and oil prices? You put more supply on the market, since the oil companies already said we're not taking extra money and spending it, in infrastructure or anything else. We're going to buy back stock and pay dividends and bonuses and all that stuff. They're reaping the rewards right now and loving life. And so what the government decided to do, take our reserves and put it on the market. So starting back in, I believe it was the end of March, so starting in April, I believe it was, started putting 1 million barrels a day on the market. Well, coincidentally, when does it end? It's supposed to end October 31st. What happens 1 week later? November 8th is elections, right? So you keep trying to push gas prices down till then to make us happy, right? And so if you don't believe it, you can just look right here. This actually is from the government itself, but this is the reserves we have. And you can see right here, that big red line is where we're going to be supposedly by October 31st. And so our reserves will be down around 40%, I believe it is. And so it's a lot of oil they're releasing every day. Imagine 1 million barrels, right? And this is supposed to be used for emergencies. And so I guess, $5 a gallon gas is an emergency. So, and we hadn't seen these prices or seen this kind of reserve decline since 1983, that is, I believe. And don't forget, understand that they have to buy this back eventually. I've read they're going to buy it back in 2024. I've also read they're going to start buying it back at the beginning of 2023. That I don't know yet. But understand, simple economics. What happens when all of a sudden you're getting 1 million barrels of oil on the market a day? Price should come down because you have a lot more supply. Well, what happens when all of a sudden that million barrels of oil is not coming on the market every day? That means you have less supply, so the price should go up. I believe Goldman Sachs is predicting a $1.25 increase in gas by the end of the year. That will take time to filter through, and to understand how big 1 million barrels of oil a day is. Texas is our largest producer of oil. They produce on average 5 million barrels a day. Right, they're the largest by a country mile. Alaska is a big one too. They only produce 500,000 gallons a day. And so again, that's why I'm telling you 1 million barrels a day is a lot. And they're going to continue to do that till October 31st and before they get your vote. And so, that's one thing you're looking at there. And so understand, if you start to see gas go back up, which is a big concern coming in winter, all of a sudden prices start going back up. Well, that's not a good thing, right? And, if you look at what's going on with housing, obviously mortgage rates are hitting new record highs and people just aren't buying houses. So guess what? They're sitting on the market for a lot longer now. As you can see right here, this is the median days on the market. You see it popping up right there around 26 now. And then when you see year over year percent change at the bottom there, you can see it's been increasing, which, it should not be a shock to anybody, for crying out loud. I mean, who wants to buy a house that's way more expensive, and then between 5.6 and 6.3% 30-year fixed mortgage rate now? I mean, that's not a good thing to have, right? But the most important thing to me to look at is rents. And this is the United States average rent price. You can see in the corner right there, I believe it's around $13.80 now, and which is just unbelievable. And you can see if this is a stock chart, I mean, you'd be making a big ROI, right? I mean, that's a huge increase since the middle of 2021 till now. And it's gone up so fast. The good news is you can see how fast they were increasing every month. Every month is increasing less, but the real thing to look at though is still increasing, like 8% a month. And that's just unsustainable, right? I mean, people just can't afford that. And so that's a huge problem. But the reason why, these companies can get away with it, or people renting their own houses all can get away with it, is because what's the alternative? People aren't going to go buy homes, right? They're going to rent. And so that's why they can keep doing that until they can get a lot of supply and get the prices of houses down. And when mortgage rates finally start to come back down, then you'll see that revive. But as long as that part of the industry is slow, rents will continue to increase. I mean, they're just not going to come down anytime soon. That's one of the biggest parts of core CPI. And another big problem we also have going on, which kind of helps with inflation, actually, believe it or not, is the dollar. I mean, it just keeps going up. People keep calling for it to fall. But I said months ago, if you look at past history, don't think for a second it can't go higher, right? It went higher in 2015, and it's gone higher than this in 2009, and you can see for yourself where it can go from here. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. And of course, that will hurt earnings for the bigger companies who do a lot of revenue overseas. We've already talked about this. A lot of them already marked it down. I think people thought, because the dollar started to kind of fall back in line a little bit, it was going to drop a lot. Well, it didn't. Now it's higher than it was last time we reported earnings, right? And so that's really going to hurt companies like Apple and the rest of them, because you can see what's going on with the euro right now. It's a hot mess and declining. So they have to end up, getting that money and putting it back into U.S. currency when they report earnings. So that hurts them on the exchange rate. And so, that's something to keep in mind when it comes up to third quarter earnings as well. And so the other thing I want to talk about, and the last thing I want to talk about really, is this right here. This is a chart that came out, and it starts talking about market bottoms, right? And this was perfect because I got to go through and look at a chart for you guys and actually show you this. And this is market bottoms, Fed rates. This comes from B of A. And you can see the market bottoms in 2000. I'm just going to focus on the 21st century. That's all I care about right now. Didn't even come until the Fed fund rate was basically either to 0 or 1%, or had bottomed out, whatever they were going to put it to at the time. The last two times this happened, in 2020 and 2009, it was 0% interest rates. And you can see the bottom didn't come till then, which most of you should be asking yourself this question right now. Wait a minute, the market started to rally in June because they said they would pivot and stop raising rates, and we're going to go to all-time new highs. When you look at that, and you're like, wait a minute, in the 21st century so far, until they get down to whatever the bottom is, whether it be 1% or 0%, whatever they're going to take us down to, now it's just 0, right? Then that's when the bottom comes in. Well, why would the bottom come in if we're just going to stop raising rates and hold them, right? Or even start to decline the rates, right? Because you can see clear as day, and I'm going to show you a more close-up view of this. Because if we go back right here, the dot-com bubble, you can see plain as day, the stock market is tanking right there, and what happens? They're lowering rates the whole time, right? Down to, I think they got down to like 1.5%, whatever was the bottom back then. But you can see the stock market just kept falling for another 2.5 years at this point in time. You can see it did a little pop right there, like 3.5%, when they started initially lowering the rates, but then the market just tanked. And then if we go over to 2008, you can see exactly what I was talking about before when I was saying when interest rates go up, and pay close attention to this, the stock market goes up with it, all right? It's not like it tanks the market, right? And I'm going to talk about that in more detail in a second, but what happens here, they cut the rates. What's happened to the market? It's falling the whole time until they get down. At this point in time, it was 0%, I believe, and then it eventually hit a bottom and started to rally. But it had already been at 0 for a while, so it's not like the interest rate is the be-all, end-all of things, okay? It just helps the market recover faster because all the money is really, really cheap. And then we move over here, you can see this was 2018, 2019. They don't count this because this was an actual crash. It reached like 19.7%, I believe the S&P did. And, when you see right there, they were raising rates, but what's happening in the stock market? It's going up, right? It's going up. And you can see it finally starts to drop, but it started to drop after they're already decreasing. I'm sorry, it didn't start to drop in 2019. I'm talking about 2020. This is 2020 right here. You can see they don't even count 2019, but you can see the bottom didn't happen until we got to 0%. 2019, you see that blip right there? I mean, it's just a blip. It was 19.7%. They were raising it into rates. We had a tantrum. They announced in February of 2019 they were going to not raise rates anymore, and the market got really happy and fat off of that. But this is 2020. Again, it's not the be-all, end-all of things. But when you go over to now, what's the difference? This is the key difference you need to pay attention to. Look where the market's heading before they even started to raise the rates. It was already heading down. Where is it still heading? Down. Where are rates going? Up, right? And we're already almost to 2019 level right now. Very close to it. And so looking at that chart, this tells you this is why all the metrics have been off, all the so-called experts and economists. I mean, think about this. The Fed has 400 PhDs. They weren't around in the 70s. So all those PhDs have never had to put in their models to fight this kind of inflation created by shutting down the world, right? Never happened. Here we are, increasing rates, you can see by the chart, the visual, into what? A slowing economy, right? The stock market's fallen even before they started raising the rates. And so that, you have to step back and say, wait a minute, the market told us they rallied in June because the Fed was going to pivot and start cutting rates way off in like March of next year. Well, looking at that in the 21st century, in this kind of stock market we're in, where algorithms run it, where there's so much leverage, it's insane. Look what's happening in Europe right now. What they're having to do, the government's having to step in to prevent a Lehman moment, right? Because of margin calls happening right now with the energy companies and their hedges. Imagine that, almost like they're saying like 1.5 trillion or something mess they got going over there right now. Also, where you got more retail investors involved. Also, where you have a economy and a stock market that is absolutely tied to the government intervention that it gives them with cheap money, free money, stimulus, all of this stuff, right? And so, to do this is why this is another chapter will be written. What happens when you increase rates into a slowing economy or into a contracting economy that on top of it has very high inflation? That right there is what we're going to get to find out and read about a couple years from now, because we're going to get to see what happens. We've never done it before. So we'll get to use this data going forward. But this is just one of those things why I call BS on the market when they try to tell us, when they pivot, we should go to all-time new highs. Well, according to this, we don't even hit a bottom until you actually hit 0% interest rate. So they've already lowered them all the way down. Well, right now we're going to hold. We're not going to get up there. They're going to try to hold the rates between 3.5% to 4% if they can, as long as they can, to get inflation under control. I just showed you rents. That makes up, like household stuff makes like 40% of core CPI. So you tell me, how's that going back down to 2% anytime soon? I don't see how at all, unless people have the goodness in their heart and companies say, let's stop raising the rents. Let's lower them. Is that really going to happen? No. And the other big thing to think about is, which we just talked about, right? How are energy prices not going to go back up if October 31st, the deadline is actually honored and they stop releasing 1 million barrels of oil every day onto the market? It's simple economics. Gas has to go back up. Oil has to go back up. When oil goes back up, everything else goes back up with it. And that's why people are really worried about the wintertime. But the politicians, will they care? Absolutely not. They've already bought your vote, whichever side you went on, right? And so they don't care. They've already got elected for another 2 years. So it doesn't matter. And to them, that's why President Biden even says student loan debt payments, we're not pushing them back anymore. You'll start forking over that money, which, by the way, will be an average of around $300 to $400 for a lot of households. They will have to pay starting next year. So that's a whole nother bill on top of it. And so when I look at that, does that look well or bode well for earnings? Going into, I told the members this morning, fourth quarter and then first quarter of next year. I think third quarter is going to be the same as it was in second quarter, where the bar is going to be on the ground. All they got to do is trip over their feet and fall across the line, and the stocks might hold or go up, because, again, the stocks are still going down, right? They're still very beaten down, a lot of them are. And so, but fourth quarter and first quarter is where we're really going to get to see, like, how is all this affecting? If oil starts spiking back up, which it should, gas prices, student loan payments start coming around again, things start moving back up again, that's where you get a group of politicians up there, all of them, who don't care anymore because now the election's over and they go back to their, same thing of never passed anything. Where are we going to be? That's really the key. And again, 2 years from now, we'll read about how this all played out and what happens when you raise rates into, a slowing economy. But look at what, not just us, it was the ECB raised huge interest rate hike, right? They're not known for that. They haven't raised interest rates in years, and here they are raising, right? Canada is another big one. Another country came out. Luckily China, they don't really care about what's going on, so they're just stimulating their economy. Like, let's go. And so, but that's where we're at. So, on a global scale, and again, the dollar, that's really going to hinder these companies. I mean, eventually you would think the dollar would have to weaken at some point in time, But, you know, that's another thing that's going to hurt all these big companies when it comes to global earnings as well. So, you know, I like to put this stuff out there as food for thought, but also want to get, you know, your thought in the comments, what you think about it and stuff. You know, obviously short term, you know, we're going to see a lot of volatilities and pops and drops or whatever. But yeah, just looking at all the tightening on a global scale, especially in this country, yeah, I don't know. The stock market going to all-time new highs. And I hear people say that, I just shake my head. I'm like, okay, you know, I never put anything past it, but that's just me. Not trying to be bearish, bullish, or anything else. Just looking at the facts and the data, you know, kind of lead me to the one conclusion. But anyway, hope you guys have a good one, and I'll see you guys Sunday, and I'll go into a lot more detail on this kind of stuff. So have a good one.